Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Friday, September 6th, 5:13 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Revere Roundup Daily Market Insight video. Market state downgraded to mild correction. Feels like a bit more than a mild correction if you traffic in leading growth stocks or in NASDAQ stocks. But the fact is the S&P is off a little more than 4% from its highs. Objectively, looking at the numbers, that's just a mild correction. But we did see a pickup in poor action this week from small caps, mid caps, leaders downgraded to bearish on our trend gauge, breaking of the 50-day moving average for most of the indexes, but the Dow still holding on and the equal weighted S&P still holding on. We'll talk about that in a second. And just as the headline says here, bad close to a bad week. Here are the numbers. Well, actually, we'll do the trend gauge first. I said downgraded on market leaders. That happened yesterday. 2 days ago, short term downgraded. Today, actually, no, today we downgraded leaders. We had them on neutral yesterday, but with 17 of the 21 below the 21-day moving average, leaders are very clearly not neutral. And that's pretty much reflective of what's going on in growth land. Yesterday, we went to short-term downtrend versus the 21-day. Today, we downgraded from uptrend to neutral on medium term, and the S&P 500 and the NASDAQ 100 are below the 50-day. Normally, that would be enough to get us to the red arrow, but we're always trying to make little bits of progress here, and I feel that a bigger emphasis needs to be put on the equal weight S&P 500 as it's holding up remarkably well compared to the market cap weighted index. And the reason for that, of course, is because of the heavy weights of tech stocks, which are acting very poorly. So we'll keep this on neutral for now with the red sub arrow. Just underneath the hood, a little bit more strength than is indicative of the overall S&P 500 on a chart. Long term, still the green arrow there. We're still above the 200-day moving average. Remember, the market never gets into serious trouble unless you break below the 200-day moving average. That's when the risk of bear market goes up. No bear market has ever occurred without a break of the 200-day moving average. So as I said, bad close to a bad week. Here are the numbers. Our 21 over 21 list really down 2.22%. One name was up strongly on an earnings gap up. That skewed it to being only down 1.46%. You take that out, the other 20 down an average of 2.22%, 17 of them down, as I mentioned, and 17 of the original 21 from this week breaking below their 21-day moving average. The big eight, terrible, down 2.85%. The RG8 is our eight growth ETF composite, also not good, down 2.15%. Basically a flat open for the indexes, but the high put in within the first 5 minutes, S&P 500 ended up down 1.7%, equal weight down 1.1, NASDAQ 100 down 2.68%, equal weight down 1.8, Dow down 1%, mid caps down 1.4, Russell 2000 small caps down 1.9, global diversified 60/40 stock and bond down 1%, our flagship portfolio GROTECTION down 1.05%, lowered exposure to the market, and we bought something today that we haven't bought in an extremely long period of time. We explained all that in the podcast, and that was a bond ETF. Well, I'll explain it to you when we get into the charts. And let's start right there. Actually, let's show this first. Let's show a monthly chart of the TLT and look at the relative strength line. Now, the reason why we normally don't buy bond funds is because, yes, you'll get a little bit of a yield, but look at this relative strength line. It doesn't even show on the chart. And the reason for that is, yes, it's a less volatile asset, but when you're trying to maximize your return, why diversify into underperforming asset classes? We say that all the time. And if you are in TLT or any bond funds, really, all you've been doing is underperforming. But relative strength has changed recently on this. And that's why we bought a bond fund, TOTL. We're evaluating a bunch of other ETFs. This one's showing relative strength against some of the other ETFs, and it has near a 5% yield. Dan talks on our podcast this week, and it's a must listen about the change in uh, the bond landscape and how now's the time to not only get yield, but also capital appreciation with interest rates coming down. Not a lot of people understand that. So for a while, we were just in the camp that you needed to own individual bonds or short-term T-bills, or expanding that into buying some bond ETFs. Let's go to the indexes now. S&P 500, clear break of the 50-day moving average now. And typical bearish uh, technical analysis happened back here, where trying to get back above the 21 day after it rolls over and starts to decline. We had one spike above it before that hard 3 day sell off, a V shaped recovery, and now a 4 day sell off and a break not only of the 21 and the 2 days prior to today. We tried to rally back above that and it acted as resistance. And you see that all the time when you break below and then try to rally back up in. The slope of the line rolls over. It acts as resistance and it's harder to get back up through, but now a clear break of the 50-day moving average on the S&P 500. We talked about the importance of that 5,500 level, which coincided with the 50-day, but that's completely off the table for now. Onto the NASDAQ 100, even weaker and only 1.7% above its 200-day moving average. You know what? It's the end of the week. So I want to also be able to show weekly charts here. So let's do that. So you can see what's going on for the week. You can see the NASDAQ 100 down 5.8% on the week, back to the S&P on the week down 4.25%. So back to the NASDAQ 100 daily chart. It's been the weakest. We've been talking about how it topped back in July on a relative basis and also on a price basis. And the first one to break lower, it's leading the way down. Normally leads the way up, leads the way down as well. Dow Jones Industrial Average breaking the 21-day moving average, still above the 50. Relative strength over the last 2.5 weeks as it's been losing less, still down 2.9% on the week. S&P 400 mid cap, mid and small were holding up for a while, but now 4 days down as well, and appears of the 50-day moving average down 4.9% for the week. The Russell 2000 also breaking the 50-day, down 5.7% on the week. Here's the RSP, the equal weighted S&P, breaking the 21, still above the 50, down 3.1% on the week. You see the relative strength there against the market cap weighted S&P 500, and that's been going on since that July CPI report as well. So what that means is money rotate, because the tech sectors are such a big component of the S&P 500 on a market cap basis. Money coming out of them and into the other sectors. It's like the elephant jumping into the bathtub. It exacerbates the move up higher in those other normally value sectors that are smaller than these tech sectors. That's why you see the equal weighted taking off to the upside. And if you look at the individual charts of these value sectors, and we did that on the podcast as well, they're showing relative outperformance and price outperformance. So there's your equal weight. Let's jump next to the VIX. VIX not doing what we want it to do. Sharply now up again at to the 2238 level today. That was actually up 12%, not 2.6%, but up 49% on the week. And so fear obviously creeping into the market. Let's look at the US dollar. The jobs report came out before the open and it was weaker than expected. And the more you dug into the details, the worse it got, because they revised July and June both lower. And initially we chopped around, but like I said, made that high after the first 5 minutes, and then a very harsh morning sell-off before starting to go sideways in the afternoon. But here's your dollar. Volatile today, ended up positive by just a bit. Let's look at the precious metals now. Gold down 0.74%. Chart still looks great, showing relative strength, holding the 21-day moving average. Gold stocks, not so much, breaking the 21 and the 50 down 2.71% today and 6% for the week. Silver, also weak, down 2.9% today, breaking back below that 50, failing at the 50-day, breaking back below the 21-day. About Bitcoin, yikes, down 4.5% today, down 8.9% for the week. We don't own any of this for any clients. To us, it's just another asset class. We'll be in asset classes when they're showing relative strength. We won't be in when they're showing relative weakness. On to bonds now. Uh, bond Bonds were volatile today as well. By the end of the day, they were mixed depending on their duration. The broad bond index up slightly. TLT basically flat, up 3.2% for the week, though. Bond prices up means yields down, and that was what Dan talked quite a bit about on the podcast today. But this looks like it looks like it's a possible shakeout. So we will monitor this low on the yield, and keep an eye on, of course, the interest rates. And as I said, that bond fund that we bought as well. The setup is there to get not only the yield, but also capital appreciation from the net asset value. That's the TNX, the 30-year, the TYX, the TNX, the 10-year, also volatile, ended up down on the day, but spiking off the lows. All right, so that is our inter-asset correlation chart section. Let's go to the tail of the tape. And I've got to bring this on the screen here. Okay. So as we said, market stayed updated to mild correction. The keys coming into today, what the S&P do against its 21 and 50 day, clear break of the 50-day. Non-farm payroll reaction, we chopped around and then broke big time to the downside. Expectations now decidedly negative with the clear breaks below the 21 in the S&P joining the weakness in the NASDAQ 100. 05 equals high. That means the opening 5-minute range produced the high for the day. We monitor when you see that, and it's very similar to the 30-minute range that we talk about. But when the high's in for the day and you're trending lower, just plain and simple, it means the bears are in charge. Stay away. And that's what we saw throughout the day on the price action. A little bit of a spike higher after the open, but then this hard 90-minute move lower. 10-minute bounce as one of the hawkish Fed heads talked about cutting interest rates, but that bounce was sold with two hands. We made a lower low before chopping into the close. 10 out of 11 sectors down, one of them flat, that one being real estate. Led to the downside by tech, gold and silver stocks. The only to the upside was home builders, ITB, and the dollar. We got stopped on Uber, and our Tesla buy from yesterday. Buyers yesterday in Tesla, sellers today, plain and simple, respect our stops. We trimmed some UPRO on the clear break of the 50-day moving average and that TOTL bond fund that we bought. Brings our exposure down, our adjusted beta down from 0.7 to 0.5. So basically half of the risk of the market now, with things looking not so good. It's basically where we are now. We've got three positions remaining, 2% size in Lilly, Race, and Kava. The rest of the stock portion of the portfolio in cash. Added a bunch to Treasury bill, money market mutual funds today to get some better yield, and dipped our toes into the bonds. But 0.4 or 40% of the S&P exposure is what we maintain as long as we're above the 20-week/100-day moving average, and really not looking to make any buys. There'd have to be a compelling argument or some strength coming into the market. Thought we saw that yesterday with Tesla, but we took the 5% loss on a 2% position on that. So the keys for Monday are we're between the 50 and the 100-day on the S&P. We're between the 150 and 200-day on the NASDAQ 100. We'll be monitoring those support and resistance levels. Bottom line, bad close to a bad week. S&P mid cap, small cap break the 50-day moving average very clearly. So let's see what next week brings. The only charts I'm going to show today are the few survivors from the 21 over 21 list that started for the week. One of them we added this week when TMDX broke not only the 21 and the 50 day, but here's a firm earnings winner, day two higher high, day three higher high, sold off along with the market on lower volume, but 4 day sell off now, sitting on the 8 day moving average. It's the leader. The market is holding it back after a great earnings report. Hava, we still own a 2% position in this. That 110 level, the low of the gap up day, is very clearly acting as support, and the relative strength line continues to impress with this one, while the market does not impress. IoT, here's the earnings winner on the day, did hold its gap, closed a little better than halfway up in the range, up almost 14% on 300% average volume, but not interested in this because of the state of the market, but definitely a good reaction. Fortinet, still the strongest of the cybersecurity stocks, down today, but still holding the 21. And Ferrari, we still got a 2% size in this, sitting right on the 21-day moving average. But volume picking up on this over the last couple of days. This pullback, we'd have preferred to see it on lighter volume. ITB sitting, this is the home builder ETF, started the day strong, faded as the day went along, basically sitting on the 21. Now, ServiceNow also sitting on the 21. The rest of these names, well, actually, C is still above the 21 as well. So it's actually 15 of the 17 broke below the 21-day. 15 of the 21 broke below the 21-day moving average. And then they start to get worse. App breaking the 21, Palantir slightly below, well, actually sitting right on the 21. This one is continuing to show. And look at this after hours. I'm guessing it was added to the S&P 500. They, yep, right around 5:30 they put it out. So this is reacting positively. Looks like Palantir's added to the S&P 500. So this will stay on our list for next week. Uh, it's not a layup to buy something just on the fact that it was added to the S&P 500, as CrowdStrike, GoDaddy, and KKR were added last month, but Palantir definitely acting well. Eli Lilly broke the 21, Dash broke the 21, Axon sitting on the 21, Uber below, for below. Now, the B-rated stocks in the market are still above the 50-day moving average, and there are quite a few of them. Leaders, ideally, you want to see them hold the 50, even if they break the 21. The A-rated stocks are still above the 21. Anything else shouldn't really even be considered, especially if you broke the 50-day moving average on volume. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. I had a great time on IBD Live today. If you get a chance to watch that, what a great crew, and great market talk on that. Really got to talk about the way we do things in the shop here at Revere and evaluate stocks. So great experience there. And if you're we always like to hear from you. If you're interested in becoming a client, email me, don@revereasset.com, or my partner, Dan Stewart, dan@revereasset.com. The phone's 855 Real Wealth. That's 855-732-5932. I always say it's not how much you make in the market, it's how much of that you can keep. And that's why our flagship portfolio is named GROTECTION. Grow assets during uptrends, protect them during downtrends. Very clearly, across the medium and short term, we broke uptrends recently, just the longer term trends intact. That's this black line here, the 200-day moving average. This is where you need to be massively concerned if this level breaks, and it hasn't yet. A lot of growth stocks have broken. The NASDAQ 100 is weak. The S&P weak on a short-term and medium-term basis, same as small caps and mid caps now. Dow holding up better, but that big black line is our line in the sand, so we don't go to 100% cash until we break that level. And with that, I'll wrap it for the week ending September 6th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great weekend.